Hello, welcome. My name's Ethan. Make sure to check out my website, ethanwrenn.com. For there, you can find links to all my various socials. We're currently live on Twitch, YouTube, and the front page of my website. If you'd like to get notified when we go live next, make sure to follow or subscribe. While we're here, make sure to check out my website, right? On my website, I have a blog, and I'm regularly updating it with new information pertaining to investing, whether it be ETFs, companies, gaming, emulation, all these different things. It's quickly becoming one of my primary outlets, and I just wanted to make sure you guys knew that it existed so you could potentially look into it. I'm putting a lot of work into it. So the video we're going to be watching today is Opportunities and Risks in Sector Investing from the official TD Ameritrade account. Let's see what they have to say about investing in sectors of the economy.
Stock market is commonly broken down by the types of businesses that have similar products and services. These divisions are known as sectors. The S&P 500, one of the major stock market indexes, has 11 sectors including consumer discretionary, consumer staples, information technology, communication services, healthcare, energy, utilities, materials, industrials, real estate, and financials. These sectors are often broken down further by industry groups.
Something on my channel that we cover often are these sectoral ETFs, right? You might have your XLK, your XLY, your XLP, your XLI, all those XL series ETFs that you see me talk about so much on my channel. For example, if we come over to my channel, we're right on the front page of it, right? Currently live, that's us. But if we click here, there's a search bar. I'm not sure if you guys even knew that. And type in something like XL. Wants us to be a little more specific, right? If you look at like XLF, right? Here's the financial sector. We did this video 5 months ago. It's definitely something you could look into. We have like the XLK. Here's like technology, right? We did the technology sector 7 months ago, when it was at the bottom, when it was at that weekly 180 moving average support, and since then has grown massively. But we had a video about that. You could have watched it here on the channel. But again, just go to my channel and you could look up a lot of these different sectoral ETFs that we're about to be learning more about.
For example, the financial sector's industry groups include banks, capital markets, consumer finance, diversified financial services, and insurance. A common sector investing strategy is to adjust how much you have invested in certain sectors based on market conditions. For example, if an investor thinks oil prices are going to rise, they may invest more in the energy sector. Also, they might invest in the industrial sector if they believe energy companies will need to purchase more heavy equipment for drilling and transporting oil to meet demand. A common way to get exposure to specific sectors is by investing in mutual funds and ETFs designed to track them. Investing in an entire sector is more diversified than individual stocks, which usually means sector investing.
What's good about a sectoral ETF is, just like standard ETFs, instead of buying a singular company, you're buying a basket of companies that represent an entire industry of a country, which is a great way to diversify your risk. If you own a singular, if you have the choice of investing into a singular company or an ETF that represents a very diverse holdings across a singular country, if you were to invest in the ETF, your risk is reduced by as much as 75% relative to holding that singular company, right? Now, if you were to invest in an internationally diverse portfolio with that's just as diverse as that US portfolio, but also has things from maybe the Asian markets, whether it be China, Japan, Korea, maybe you have some Europe with the United Kingdom, Germany, maybe India, Austria, right? You've now reduced your risk as much as 85% relative to just holding that singular stock. And that's roughly what, another 40% from just the US portfolio. So it's really good to diversify, whether it be via a country, whether it be via a singular sector, whether it be internationally. This is a great way to smooth out your returns year over year of your personal portfolio.
Is less risky than buying a single stock. However, sectors are still more concentrated than a broad market index. This means they have the potential to achieve higher returns than the broader market, but have greater risk because of the lack of diversification. For example, take the tech bubble of the early 2000s. Investors who thought this phenomenon was a sure thing and loaded up on tech sector stocks likely experienced greater losses than more diversified investors when the bubble burst. This is why many sector investors choose to allocate just 5 to 10% of their portfolio into a certain sector. Understanding risk is an essential step for making your investment choices. This graph illustrates the risk and return relationship of the S&P 500 and its sectors from 2002 to 2022. The return is
Note how you have return on the left, risk on the side. So the risk would typically be like the standard deviation, and your risk-free rate would probably be what? And right now, it'd probably be around like 4.5%. As historically, it'd probably be a little closer, what, like 2.5? Something to keep in mind.
the annualized average for each sector over the 20-year time frame, while risk accounts for how much returns tended to vary month to month, known as standard deviation. Using the S&P 500 as a baseline, we can see that it averaged a return of about 8% with risk that was a little more than 14%. The information technology sector had the highest returns near 11%, but it was also much riskier than the S&P 500 with a standard deviation around 21%. Financials were the worst performing group with an average return near 4%, and it was a volatile sector to boot, at 22%. The consumer staples sector had the greatest returns relative to the risk. It averaged about 9% with less than 12% standard deviation. In fact, staples, healthcare, and utility sectors, which are commonly known as the defensive sectors, or sectors investors turn to during rough markets, all performed well compared to their respective risk scores. Remember that past performance cannot predict future results, though it can show how a sector has historically behaved and how it compared to other sectors. Understanding stock sectors and how they perform can help you fine-tune your investing strategy for different market conditions.
I think that was another great video from TD Ameritrade. Again, it really helps further explain the types of opportunities and risks you can expect to receive when investing in sectoral ETFs. I thought this was an important topic to cover because we do a lot of this on my channel. We're going to be moving into our next video here.